Super Bowl Sunday is here, so I am sure all of our listeners on 96.9 The Game are excited for the day ahead, along with our listeners on our other stations here in Central Florida, right? Who doesn't sit around and watch the Super Bowl, at least for the ads or maybe the Puppy Bowl, although I think the Puppy Bowl is on like a different network, so you got to track that one down. Anyway, if it's Super Bowl Sunday, you know, each and every year we have to talk about perhaps one of the silliest market indicators, and that is the Super Bowl market indicator, as we like to do each and every Super Bowl Sunday. So we'll obviously be talking about that, along with one of the scourges of market volatility, and that, of course, is panic selling. We're going to be joined later on in the program by one of our fellow certified financial fiduciaries at Nelson Financial Planning, Garrett Fields, to talk a lot about that particular topic, how you might be able to avoid it, what you might need to do to kind of avoid that notion of panic selling. So all of that coming up here on the program. My name, of course, Joel Garris, certified financial planner, certified financial fiduciary at Nelson Financial Planning, where our team of certified financial fiduciaries like Garrett Fields stands ready this week to help you change your life with a successful and cost-effective financial plan. So Super Bowl Sunday, we got the Los Angeles Rams facing the Cincinnati Bengals. And of course, the Super Bowl market indicator is one of those kind of odd market indicator things that just sort of came out of nowhere, and it's that time of year where you hear folks talk about it. So what exactly is it? Well, started in the 1970s. It was sort of discovered, if you will, by a guy by the name of Leonard Koppett. And in that, or at least in the 70s, he realized that at that point in time, his version or his creation of the Super Bowl market indicator had never been wrong. So here's what it is. If a team from the American Football Conference, or the AFC, wins, then that portends a down market, a bear market. However, if a team from the NFC or a team that was in the NFL before the NFL-AFL merger wins, then that would predict a bull market or an up market. Okay, so that's how it all plays out. Here's how it has played out. So when Leonard Koppett discovered it back in the 70s, it actually had been right 100% of the time. Well, obviously, since the 70s, there's been a few more years, and so there's a little bit more data on it, if you will. And so out of the 54 years of the Super Bowl, it actually has been correct 41 times. So that's pretty good. That's actually like a 76% accuracy rate. Certainly better than a coin flip. Certainly better than Puxatawny Phil that we were talking about last week on the program. That groundhog is only right about 39% of the time, according to the National Weather Service. So that's a little bit more accurate, right? Maybe the Super Bowl indicator should flip to some sort of a weather-related indicator. Poor groundhog, he's just not very accurate. Anyway, of late, there's been a little bit of a mixed bag on the Super Bowl indicator, right? Last year, of course, the Bucks won. Yay, go Bucks, right? They're out of course, the NFC. So that meant that if the market indicator was going to hold, that you would expect the market to go up. And lo and behold, last year, it was a positive year for the market. So in that case, the fabulous Super Bowl market indicator was correct. However, if you go back 5 years, it's been wrong for 5 years prior to that, 5 years straight prior to that. So it's fallen off a little bit in terms of its accuracy of late, but leave it to Tom Brady and the Bucks to right the ship on the Super Bowl market indicator. So we will see how all of that plays out. If you like markets going up and how that works well in an investment portfolio, then I guess you are a Cincinnati Bengals fan. So otherwise you would be a Rams fan. And are there any Rams fans out there? Like they went from St. Louis to Los Angeles, and who knows where they're from. Anyway, Bengals, you know where they're from. They're from Cincinnati. They've always been from Cincinnati. So great story coming out of Cincinnati. So yeah, I'll probably wind up rooting for the Bengals. Plus, also makes sense, right? From a market perspective, certainly the Super Bowl indicator would say, yeah, you got to root for the Bengals. So anyway, so that's the Super Bowl market indicator. Looking back to last week, we certainly had a pretty interesting week around the office, obviously gearing up for tax season, but also had the opportunity to have another one of our regular conference calls with investment portfolio managers. And that's something that sort of we started during the COVID times, if you will, where you were able to have in-person meetings. And we certainly got some good response of folks that like to have the opportunity to dial in and to sort of hear a presentation and to hear a conversation about what's going on with the economy, the markets, the world at large. And so we said, well, you know, doing a conference call, we're going to keep doing those. Even though we've had our in-person client events return, we started those back again in the fall, obviously with some changes in sort of this new COVID normal. But at the end of the day, we are also continuing those conference calls as well, because our view, as has always been the case, is you cannot be overly educated about what it is that your money is doing. And so we have pretty much an event for our clients nearly about once a month now on average, between the quarterly in-person meetings, between the quarterly conference calls, and between some other things that we do during the year. So anyway, last week had a conversation with an investment management manager, and it was an easy conversation to have, because if you look at the headlines, it did not take me long to figure out exactly what needed to be on the agenda. I sat down that morning and wrote out 9, and I actually added a 10th one in terms of our topics. So we talked about Ukraine, talked about Taiwan, talked about interest rates, talked about inflation, talked about global technology, emerging markets, COVID, market volatility, tax changes, and then of course we added one in there, that discussion between value versus growth. So certainly some interesting discussion that we were able to have this past week. And I guess in summary, it's always interesting when you think about what the headlines are versus what you actually hear having boots on the streets in those localities. And so certainly that was sort of one of the interesting takeaways, is that oftentimes the real story that's actually happening isn't the story that's playing out in the headline. So some interesting conversations on that as well. We're going to take a break. When we come back, we're going to talk about market volatility, one of those topics that we talked about on the conference call this past week. But we're joined in the next segment by our fellow certified financial fiduciary, Garrett Fields. Coming up next here on Dollars and Cents with Joel Garris. Welcome back to the program. Just thinking a little bit about market volatility. Obviously, that was one of our 9/10 topics that we covered in a conference call with our clients and investment portfolio manager this past week. So we thought it would be a good topic to expand upon a bit. Certainly something that we've been talking a bit of late, particularly this year, as market volatility has been increasing a bit. And so one of the scourges, if you will, of market volatility is this notion of panic selling. So Garrett, welcome back to the program. You've certainly joined us in the past, and so we are pleased to have you back on the program. Tell us a little bit about what panic selling really is all about.
Sure. So panic selling is a movement where investors or a group of investors decide to move their investment strictly into cash, especially their equity investments in the market. They just decide that they're done with it. They throw in the towel and they move everything to cash because they feel like it's a little bit safer.
And usually that occurs when headlines are screaming something negative that is happening.
Yes, it's not always about what actually is happening, as you said in the last segment, but what the headlines are saying. Yes, that can trigger a lot of panic selling.
And probably the most recent one that I know we've experienced is when the COVID shutdowns all started happening, right?
Yeah. The latest variant of COVID has that market's always a little worried about that.
Correct. But then when that all first started back in March of 2020, I mean, that was a pretty significant decline within a very, very short period of time, that's for sure.
Yeah, I believe that was one of the quickest bear markets ever in 2020. I think it happened in 22 days, and the previous quickest was at 23.
Yeah, so very, very sharp decline. And so those kinds of things obviously create panic selling. What does that wind up doing to the markets?
Sure. So it's actually artificially pushing prices down, but the big difference is it's not just because the prices of a security get pushed down does not mean the quality of said security gets pushed down. So you pretty much just put the same quality security on sale. The price gets pushed down and you decide to let it go.
Well, and that's a fair distinction, the notion between the price of a company or a security versus quality. And over time, price is ultimately going to reflect the quality of that company.
Over a long period of time.
Correct. But in a short period of time, sometimes there's a disconnect.
Absolutely.
And those headlines can often drive that disconnect pretty dramatically.
That's correct, yeah.
And then that leads, of course, to this notion of panic selling, where more and more people sort of join the herd, if you will. And once you see it start out with a few people, and then more and more people join that same few people, then it keeps growing and growing and getting larger and larger and larger. That is for sure. So that's panic selling 101, if you will. How should somebody avoid that?
So we have a couple ways that you can avoid it. First, it actually starts before you even invest. It's building a portfolio that's designed for you. The reality is that a 100% stock portfolio over a long period of time is probably going to have the best rate of return. But that doesn't mean it's going to have the best rate of return for you. If your portfolio is too volatile and going up and down too much, and that causes emotion to creep in and causes you to sell, that's not the best portfolio for you. Maybe you should go from an 80 or maybe 100% stock portfolio down to a 70-30. Because whenever you have a 70-30 of 30% of your portfolio sitting in bonds, that's 30% that's not affected by the market whatsoever. So obviously your portfolio is going to fluctuate less. That's just less decline. It's a little bit less return, but it's less decline, less emotion that creeps in, and less room for mistakes.
Sure, and that really underscores the difference between stocks versus bonds, right? Stocks obviously have a lot of volatility. Bonds don't. Not to say that bonds can't go down, particularly kind of when you have a rising interest rate environment. So just like stocks, on the bonds, on the stock side, you have to know what you own and not just own smaller companies or mid-size or emerging market, but know also what you own on the bond side. What's the term? Is it a long-term bond or a short-term bond? The reality is that long-term bonds would be more affected by interest rate increases, and you would see the value of those bonds go down. But even in the worst declines, your bonds don't go down anywhere near the same level of as the stocks do. So that's a great point. One of the ways to avoid panic selling is prepare to make sure that your portfolio is positioned where it needs to be to not have that be an issue in the first place.
And it's really about knowing yourself. Mm-hmm.
And being able to, I guess, keep that long-term perspective.
And that's a great way to segment into the second point is, keep long-term perspective. How long are you investing for? Are you willing to kind of throw in the towel for something that happens over 3 months, even though you're investing for the next 20 years? Or are you invested for the next, couple months? And as we know if you're invested for 2 or less years, the market probably isn't the best place to put your money. It's just too volatile and too short of a time frame.
Given that short of a time frame, if you think you're going to need that money within a year or two, probably shouldn't be investing in the first place. And I think that's one of the things that a lot of people are struggling with right now is, well, I understand that, but I'm not making any money if I sit in a cash or a savings account or a money market. But that's the trade-off. And so we think that it's more important to make sure that that money that you need stays more on that secure side of things rather than get into investing it. That's for sure.
And I mean, one of the things that you can look at is 2008, second worst financial decline we ever had, really, really bad. Not going to sugarcoat it, but during the peak of 2008, the market S&P was sitting somewhere around 1,560, somewhere around there. Today, even with the level of volatility we have, it's at 4,600, so it's up quite a bit. Even though we've had plenty of things that have gone wrong over the last couple of years, market's still chugged along.
Well, and I think that underscores sort of the hardest thing. If you get into this notion of panic selling, if you fall victim to that it becomes really hard to know when to get back in. I think the decision to panic sell is in fact probably one of the easier decisions that you can make as an investor, but that then leads you to now have to accurately figure out some much more difficult decisions of when to get back in. And I think that's really probably one of the biggest struggle that people have, particularly when we think about cash on the sidelines and how best to invest that.
Well, yeah, I think that's perfect because as the market starts to go down and you start to feel this emotional burden on you, you want to do something. And a lot of times the easiest thing to do is to just sell and throw your hands up. But sometimes there's other actions that you can take to make you feel certain to help manage those emotions. One of those things is investing cash. Obviously, whenever we say invest in cash, we don't mean dip into your emergency savings. But if you already have 6 months of savings on the sidelines and you have a little bit more, maybe you can flip the script from, oh my gosh, the market's falling, to, hey, maybe I can take advantage of this opportunity and buy something on sale.
Well, and that's a fascinating point, Garrett, because there's two stories that I always like to tell. And one, if you're a long time listener of this program, was a story that my father-in-law, Jack Nelson, would often tell, and it was the tuna fish story. So the tuna fish story goes something like this. His wife went out grocery shopping and came back with 6 cans of tuna fish. And Jack looked at June and said, well, why did you get so much tuna fish? It's just, it's just the two of us. I mean, why do we need 6 cans of tuna fish? And she said, well, it was on sale. So we bought it because it was on sale. I know myself, I used to fall prey every time I went to the grocery store to the fabulous BOGOs at Publix, buy one, get one, right? So you gotta get 2, even though it might not really have anything to do with what you need. And I guess the interesting thing about that story is, what's fascinating about that is it gets to the emotional nature of money and how we spend money versus when we think about investing. Because when we're walking into the grocery store and seeing tuna fish on sale, the inclination is that we're going to buy it. Not only are we going to buy it, we're going to buy more of it. But when it comes to investing, we don't have that same mentality.
Yeah, it's odd. I mean, same thing, people are scared to invest because they're scared to lose money. Well, the reality is anytime you put something on a credit card, that money's gone too. So, which would you rather take your chances with?
Well, I got my other story that I'm going to tell as well. A good old buying on sale story. We'll do that when we get back here on Dollars and Cents with Joel Garris, joined by Garrett Fields today on Super Bowl Sunday. Sharing an old story with our listening audience during that last segment. The tuna fish story was one that for years we would talk about extensively on this story because it was a favorite of my late father-in-law, Jack Nelson. The notion of how we spend money, how we work with money, how we relate to money is very different when it comes to spending or consuming versus investing, right? You go into the grocery store, you see the tuna fish on sale. In my case, I saw the BOGO, and I would always go double up on the BOGO. And you buy way more than what you need because it was on sale. But for whatever reason, when we think about the markets, people kind of don't have that same thought pattern in terms of how to approach it. Similarly, the story that I always like to tell is the notion of a shirt, like a shirt that's on sale. You walk into a store, you see a shirt for 20% off. You think, that's fabulous. Okay, I got 20% off. It's the same shirt. It's going to cost me 20% less. But you think, well, wait a minute. This store has a tendency to place stuff on sale on a regular basis. I wonder if I come back next week that shirt might be 30% off. So maybe I'll wait and I'll just see if it's going to be 30% off. Problem is, everybody else may have bought the shirt when it was 20% off. So those opportunities to invest on sale, to buy on sale can be fleeting. Gets to the whole problem of how do you ultimately predict the future. And at the end of the day, if you see opportunities, it's always good to certainly take advantage of them rather than, I'm going to wait and see. Oftentimes you may wait and see that there isn't the opportunity anymore. Garrett, before the break, you were talking about the analogy of when we put money on a credit card to buy that shirt.
Right. So when you put money on a credit card to buy that shirt, the money's gone. Unless you return the shirt, you're not getting the money back. And it's funny because people are always scared to invest their money because they're scared to lose money. But they spend it all the time. And anytime you spend it, it's gone. Even during 2008, I mean, as we were just talking about, if you would have invested your money at, around the worst possible time, you would have only lost 50% of your money. Today, you would have, be up 3 times, 4 times, you'd be up a good amount. So it's just funny how people think and about money and investing versus spending.
A lot, and if you go to any of your local Starbucks, which are basically on every other block these days,
sometimes two,
or a Foxtail right next door, then that is something that you don't have anything to show for it. Once the coffee's gone, it's gone. We like the free coffee here at the office. So if you're looking at the YouTube, we've got and then Garrett's got his
marketing.
This Nelson Financial Planning coffee mug as well. So for our YouTube audience, we're not hitting up on the Starbucks. But so you're talking again about the notion of how do you avoid panic selling, and certainly there's some other things to kind of think about. It starts, just to kind of recap where we are in the conversation, it starts of course with the portfolio allocation, right? Plan ahead to avoid it, and that goes directly to the investment allocation that you have. Secondly, make sure you're maintaining kind of that long-term perspective. Don't get too caught up in whatever the headlines are today. If you've got cash that's just kind of sitting, then certainly thinking about starting to take advantage of opportunities in the market to invest on a regular basis. But we've got a couple of other thoughts that we wanted to share as well, Garrett.
Right, so the next one is stay away from the get-rich-quick schemes. The reality is that these don't always play out. They can be extremely volatile, and even if you have the emotional capacity to stick with them, there's not a guarantee that they're going to work out in the end.
If everybody is talking about it, if you're going out with your buddies to the Super Bowl, if somebody is talking about something that you should be investing in at a Super Bowl party, later on today, that's probably not what you want to do.
No, and if everybody knows about it, you're not ahead of the game anymore.
That is very true. What's interesting, will be interesting to see, tying this back to the Super Bowl, is it looks like there's been a lot of ad buys by crypto platforms. And apparently there's a couple of different crypto platforms that have bought advertisements in the Super Bowl. And that always makes you wonder, okay, what's the reality? What's the reality of this? Because the last time I saw that kind of demand, it sort of starts to sound a little bit like the .com and some of the those early internet companies that would run ads on the Super Bowl to get their name out there, and at the end of the day, they really didn't have any business model to represent. So certainly staying away from the get rich quick. And then lastly, I think this one is a great one. Why don't you share this last one with us?
Oh, the one by Christina. Well.
Yeah.
So you can always take the advice of the great Christina Lamb. She's a IRS enrolled agent, a fellow CFF, and a fellow UCF grad.
Trying to get on the good side of her by calling her great.
Exactly. Huh? She is. But the best thing one of the great things that she said is, if you're sitting there watching the TV and the market's falling and it feels like the sky's falling, turn it off. Go for a walk. I'm not saying that the market's not important, but it's not everyone's entire life. Your life is not necessarily surrounded by the market. So go outside, take a walk, realize the sky is not falling. I was going to say go buy a coffee, but maybe not that.
Yeah, that would defeat the whole prior conversation. The reality is, and I think it's important to note as well, you are not going to use, whatever the headline is, on whatever the day is, you're not going to use all of your assets that you have accumulated over the course of your lifetime on that single day. You're not, okay? The reality is you spent 30 years accumulating, you're going to spend 30 years spending. So in a 60-year time frame, that's like 15 different presidential elections, to put it into perspective as to how long and how much can happen during that period of time.
And you're doing two different things, so your portfolio should be set up in two different ways. And this goes back to our point number one. If you're 10 years out from retirement, you have 10 years for your portfolio to recover, so you're good. If you're in retirement and you're spending money, well, then your portfolio should look very different. This goes back to the 70-30. The reality is that even if you have a 70-30 portfolio and 6 months worth of savings on the side, 30% in bonds, that's about 6 years of spending plus the 6 months
should
of
be enough to kind of cover the decline and the subsequent recovery based upon history. That's exactly right.
Right. And so that's the importance of building your portfolio, from the get-go.
So what if I fell prey to panic selling? What should be some of the things that I need to think about? As I've said earlier in the program, you unfortunately have probably a much harder decision in front of you in terms of knowing, okay, now what do I do? So we've got some thoughts on that. So what are some thoughts for folks that might have fallen victim to some panic selling at some point in the past?
Well, first, if the market's falling and you decide to get out and you think that you're going to get back in at a better time, that's just not the case. If the market's falling and the emotional pressure is built up to the point where you can't handle it anymore, getting back into that same exact thing whenever it's even lower, that's just tough. But one of the things that you can, absolutely do whenever you try and get your money back in is build the portfolio different. Clearly, your portfolio was too aggressive. It caused too much emotion. So unfortunately, the first thing isn't actually doing anything, but it's building a good portfolio, starting with a good base, and really kind of knowing yourself so you don't make the same mistake again.
No, that's certainly important because it does ultimately always goes back to that investment allocation, and knowing that, as with any investment portfolio, there are different pieces that are supposed to be doing different things at different times. That's the very definition of diversification in its broadest sense, that you've got different investments doing different things at different times, which gives you the flexibility to weather whatever the different times are that we happen to be in.
Exactly. You use different, like you just said, you use different pieces of your portfolio depending on what's going on, and there's a reason for it.
Yeah. One of the biggest things that we like to also talk about is sort of putting money in perhaps on a regular basis. That concept of dollar cost averaging.
So
we're gonna slide to the break. When we come back, we're gonna talk about that concept itself, and then I also want to take a few minutes and clarify expand on some of the gifting stuff that we talked about on the program last week. Coming up next here on Dollars and Cents with Joel Garris of Nelson Financial Planning. On the program, we're talking a little bit about panic selling, what it is, how to avoid it. And in this particular segment, starting in the last segment, we were talking about some of the ways that you can try and overcome it if you've fallen victim to that. So welcome to the program. This is, of course, Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. We're Central Florida's longest running radio program, coming to you on a variety of radio stations throughout Central Florida, one of which happens to be 96.9 The Game. I know sports fans out there, it is Super Bowl Sunday, so there's a game on later on today that I'm sure will attract a bit of an audience. Anyway, my name, of course, is Joel Garris. I'm a certified financial planner, certified financial fiduciary at Nelson Financial Planning, where our team of certified financial fiduciaries, much like Garrett Fields, who's joining me on the program today, stands ready this week to help you change your life with a successful and cost-effective financial plan. So, talking a little bit about some of the strategies to engage in if you found yourself victim to panic selling. We talked about going back and sort of resetting sort of the mix, if you will. Maybe the mix that you had before didn't really work, and so now it's important to sort of reset what that mix might be. The words of caution on that would be don't swing too far in the other direction, right? Because
Correct.
If you're retiring and you're 65, life expectancy tables being what they are, you still got another 20 years to go. So you're going to want some growth on those assets, particularly during a time of inflation, and then also getting into the concept of dollar cost averaging. So what is dollar cost averaging anyway?
So dollar cost averaging is whenever you have a lump sum of money and you want to get it invested. Obviously, you don't want to get invested on any random Tuesday, because on Wednesday the market could fall. On Wednesday the market could go up, but the market could also fall. So it's the idea of taking a percentage, 5 or 10%, and putting it in monthly. This ensures that you get all the highs, you get all the lows, and it also ensures that you get all the money in. And in a relatively short period of time, over if you have the perspective of a long period of time.
Well, and certainly that dollar cost averaging concept is a great way to also add money to a portfolio over time as well. So there's a lot of positives that come from that concept of being regular, being consistent on your investments. There's a lot of studies that certainly have proven that over the years. Now, the one caveat on that is, and this is important, and this goes back to the concept of consistency. If you are invested, you stay invested. Okay, if you're not, how do you tackle and try and get back in? And that's what the dollar cost averaging strategy is really all about, putting money in on a regular basis so that over the next year or two you wind up finding yourself at least fully invested. Take sort of the guesswork or the predicting of the future out of that on a regular basis.
And that's a nice thing, is it takes it completely out of your hands. Every day on the 15th, money gets invested. It's not relying on you to make a decision on the market, and this guarantees that the money gets invested.
Well, and the other thing too is you can always take advantage of the sale, right? Back to that part of the conversation. If the market does go on sale, there's no reason why you can't accelerate that dollar cost averaging. Maybe front load a few months in that particular month where the market is experiencing some volatility.
Absolutely.
So certainly glad you had an opportunity to join us this week on the program. Garrett, I wanted to take the last few minutes of this segment and talk a little bit about a topic that we just sort of hit on last week on the program, but I think we kind of ran out of time, so I wanted to talk a little bit more at length with it, and it's the concept of gifting. And so often you hear folks talk about the fact of, well, I can gift money to somebody, but I know it's subject to an annual limit. So if I wanted to gift Garrett here some money, I could gift him $16,000 per year. That's sort of the limit, and that's the limit that folks are aware of. Now, That's a higher limit than last year. It's at $16,000 this year. Last year it was only $15,000. But to the extent that we're talking more than that, I think this is where people get a little hung up on, okay, well, how do I do that? And so one of the ways that you can do that is through gift splitting. So if I wanted to get Garrett more than $16,000, I could, with my wife, Stephanie, well, she could do $16,000 and I could do $16,000, and then you could get $32,000.
Sounds good to me.
Let's
rope in some more people here.
And the more people you add, then each person can give each other person $16,000. That's the notion of gift splitting, right? Splitting the gift up between multiple people. But what if it's $50,000, or what if it's $100,000 and you're trying to help a child or something like that with the purchase of a home? And I think that's where folks kind of get a little twisted around in terms of what the analysis is and how that all works. Let's set the table with this. If I receive a gift, if I give you $16,000, Garrett, or $50,000 or $100,000, if I do it as a gift, there's no tax implications. You don't have to worry about putting that on your taxes. You don't have to do it. I mean, that is yours. That is the essence of a gift, is it comes with no strings attached. So pretty good deal, right?
Yeah.
So, however, there's no tax savings to me. When I give a gift, there's no real tax savings because Garrett's not a I don't think you're a charitable organization.
I am not.
You don't look like you're a charitable organization. So there's no tax savings, if you will, to the donor, nor is there any tax impact to the recipient. Okay, but here's what you need to do if it is a larger gift. And I think this is where folks get a little confused of, okay, well, what if I go over that $16,000 limit? What do I need to do? The reality is that you're still not going to owe any taxes on it. You're not going to owe any taxes on it. The recipient's not going to owe any taxes on it, because how a gift works is we have a unified estate and gift tax regime here in this country. So that means that if you look at your estate tax exemption, which is like over $12 million per person this year, then if you give a gift larger than the annual exclusion amount of the $16,000, then you basically whittle away from that 12 million number. So if I were to give Garrett $100,000, then my estate tax exemption would be $11,900,000. My point is, given how high the estate tax exemption is, that's not really that material at the end of the day to get into the notion that, oh, there's going to be some tax impact on it. Now, what you should be doing from a technical point of view is you should be filing a gift return to technically reduce down that estate tax exemption, but that's not a return where you're going to owe money on. So understand how gifting works. To the extent you want to give a $16,000 or less, no, fine, no problem. If it's more, then there's technically a filing that needs to happen, but it doesn't create a tax bill. So we wanted to just spend a few minutes on that, talking through that one a little bit more. Anyway, we're going to wrap it up on out and get out of the program. This is Joel Garrison, Nelson Financial Planning on News Radio WFLA Orlando.